In 1990, if you had invested $100 in the S&P 500 and just left it alone, done nothing else, never checked it, never touched it, today it would be worth over $2,000. Not because you picked the perfect stock, not because you timed anything, just because you understood one idea most people never learn in school: how investing actually works. Section 1. What investing actually is. Let's start with what investing actually means, because most people get this wrong. Investing is not gambling. It's not picking a lucky number and hoping. When you invest, you're buying a small piece of something that produces value over time, usually a company. Say you buy one share of a coffee company. You now own a tiny sliver of every store, every sale, every dollar of profit that company makes. If the company grows and sells more coffee, your slice becomes worth more. If it shrinks, your slice is worth less. That's it. That's the entire foundation. Section 2. How the stock market works. So where do you actually buy that slice? The stock market. Think of it like a massive marketplace, except instead of trading vegetables, people are trading ownership pieces of companies, called shares. The price of a share moves up and down based on one simple force: how many people want to buy versus how many want to sell. More buyers than sellers, the price goes up. More sellers than buyers, it goes down. That's why prices move every single second the market's open. Millions of people are making that decision at once. You don't walk into a physical building to do this. You use a brokerage, an app or platform like Fidelity, Vanguard, or Schwab that connects you to that marketplace. Section 3. The main ways people invest. Now, there's more than one way to invest, and knowing the difference matters. Individual stocks, buying a share in one specific company. Higher potential reward, but higher risk, because your money depends on that one company's success. Index funds and ETFs. Instead of buying one company, you're buying a small piece of hundreds or thousands of companies at once. The S&P 500, for example, is 500 of the largest companies in America bundled into one investment. This is how most long-term investors actually build wealth, not by picking winners, but by owning a piece of the entire market's growth. Bonds. Essentially loaning money to a government or company, and they pay you back with interest. Lower risk, lower reward. Real estate. Owning physical property that can generate rental income or increase in value over time. For a complete beginner, index funds are usually the starting point almost every serious investor recommends, because you're not betting on one company. You're betting on the economy as a whole continuing to grow over time. Section 4. Why time matters more than timing. Here's the part that changes everything once you actually understand it. Compound growth. When your investment earns money and you leave that money invested, you don't just earn returns on your original amount. You start earning returns on your returns. It snowballs. Slowly at first, then dramatically. That's why the $100 from 1990 didn't just grow a little. It multiplied over and over across 3 decades. Time is doing almost all of the work. Not luck. Not perfect timing. Time. This is also why trying to time the market, jumping in and out, chasing the perfect moment, usually backfires. Studies consistently show that investors who stay invested through ups and downs outperform those who try to predict short-term moves. The market has always trended upward over long periods, even after crashes. So if you're just getting started, you don't need to pick the next big stock. You don't need to time anything perfectly. Open a brokerage account, put money into a broad index fund, and give it time. That's the entire foundation nearly every successful long-term investor is built on. This video is for education, not financial advice. Always do your own research, or talk to a financial professional before making investment decisions. If this helped make investing make sense, subscribe. Next up, we're breaking down exactly what an index fund is and how to pick your first one.